All right, so we're diving into LG Equipment's Ltd. It's Q2, their second quarter results for fiscal year 2025.
Okay.
And we've got quite a bit of stuff to go through. We've got their official statements, the press release, and even some snippets from the analyst call.
Excellent.
Today, we're not just looking at the raw numbers.
Yeah.
We're going beyond the surface, right?
Yeah.
See what this really tells us about their game plan and what it means for their future.
Yeah, absolutely. Context is everything, right?
Yeah.
So we'll be looking at these figures and, considering the overall market dynamics
Right.
and LG's position within the industry.
Okay, so let's just start with the headline figures.
Okay.
Consolidated sales growth hit 8%, reaching Rs 869 crores.
Okay.
Consolidated profit after tax also saw a decent rise,
Mm-hmm.
up 4% to Rs 94.7 crores. But hold on.
Okay.
Their standalone performance was even more striking.
Interesting.
Standalone sales jumped a massive 21% to Rs 531 crores, with standalone PT rising 17% to Rs 97.9 crores. This is a pretty big difference.
Yeah, it is quite a difference.
Yeah.
While 8% consolidated growth is respectable,
Yeah.
that 21% standalone jump really indicates that, LG's core operations in India are thriving.
Yeah.
This could suggest that they're leveraging the domestic market effectively,
Right.
perhaps benefiting from government initiatives or a strong demand in specific sectors,
That makes sense. And it makes you wonder if their standalone numbers are so strong, what's holding back the consolidated results?
Right.
So let's break it down by region.
Okay.
The performance in India seems to be in line with overall industrial growth, which is logical.
Makes sense.
The Middle East remains a strong market for them,
Okay.
and they're gaining some traction in Europe, but things look a bit different in the U.S., Australia, Brazil, and Southeast Asia, where they're seeing more subdued performance.
Yeah, the regional variations are definitely key here. While LG hasn't explicitly outlined the reasons, the subdued performance in markets like the U.S. and Australia
Right.
could very well be tied to the economic slowdowns.
Yeah.
We've been seeing in those regions. It could also be increased competition from local players or perhaps supply chain challenges impacting those specific markets.
So potentially a mix of external factors they don't have much control over.
Right.
Now let's zoom in on a particular bright spot. Their automotive equipment business.
Okay.
They've experienced significant growth in this segment, which is really interesting.
Yeah, the success of the automotive equipment segment is quite telling.
Yeah.
It makes you wonder if LD is strategically shifting focus.
Yeah.
Are they capitalizing on a global surge in, say, electric vehicle production? Or is this a targeted move to diversify their revenue streams?
Yeah, those are some great questions. And to get a clearer picture, let's dive into their EBITDA breakdown from the analyst call.
Okay.
For those unfamiliar, EBITDA, earnings before interest, taxes, depreciation, and amortization,
Right.
gives us a good look at a company's core profitability,
Yeah.
stripping away some of the accounting complexities
It's a key metric for comparing companies.
across different industries and understanding their operational efficiency.
Exactly. So LG sales grew by 8%, which is good.
Mm.
Their contribution margin also increased by 9%, suggesting a potentially favorable shift in their product mix toward higher margin items.
Right.
However, their EBITDA growth didn't quite match, reaching INR 1,418 million, when it could have been closer to INR 1,812 million based on the sales increase. It's a pretty significant gap.
It is. And the culprits seem to be a 7% rise in employee costs
Okay.
and a whopping 24% surge in other expenses.
Wow.
That's where things get particularly interesting. Now, the question is, are these increases a sign of trouble, or are they strategic investments for the future?
Exactly. And the analyst call presentation, while highlighting these cost increases, didn't really provide much detail. What we need to uncover is what exactly makes up those other expenses
Right.
and whether they're driving this discrepancy in EBITDA growth.
Absolutely. If we look at this, from a financial analysis perspective,
Yeah.
there are a few possible scenarios. Are they pumping resources into R&D to develop cutting-edge compressor technology? Are they aggressively expanding into new markets, which could lead to, big returns down the line?
Yeah.
Or are they grappling with, unexpected cost pressures due to, say, supply chain disruptions or escalating raw material costs?
Those are all valid possibilities. And getting to the bottom of this will help us understand LG's risk profile and future prospects a lot better.
Yeah.
So let's turn our attention to their cash flow statement. This statement gives us a snapshot of their financial health by tracking the flow of cash in and out of the company. And one thing immediately stands out. Their consolidated cash and cash equivalents decreased significantly from R's, 2,294.53 million to R's, 1,186.46 million. What are your thoughts on this?
Now, this decrease might initially seem alarming,
Right.
but when we consider the context of potential investments and expansion that we just discussed, it becomes less so. This decrease could indicate that LG is strategically deploying its cash reserves to fuel future growth initiatives rather than simply holding on to it.
So instead of sitting on a pile of cash, they're putting their money where their mouth is and investing in what they believe will drive future success. That's a pretty bold move, especially in the face of global economic uncertainty.
It certainly suggests a proactive approach. It's also worth noting that LG's cash position remains relatively strong even after this decrease.
Good point. Now, looking ahead, LG has stated that they expect similar growth in the third quarter of fiscal year 2025 compared to the second quarter.
Okay.
But given the global economic headwinds and their subdued performance in some key markets, is this a realistic expectation?
That's the key question, isn't it?
Yeah.
On the one hand, LG has demonstrated its ability to achieve strong growth, especially in its standalone operations. However, the global economic landscape remains unpredictable.
So, should we take their outlook with a grain of salt? Or could they have something up their sleeves, some strategic advantage that will allow them to defy the odds and achieve their projected growth?
It's impossible to say for sure, but that's the intriguing part.
Yeah.
We need to delve deeper into their financials, scrutinize their statements, and analyze their actions to get a clearer picture of their future prospects.
Okay, we've covered a lot of ground in this first part of our deep dive. We've looked at LG's impressive standalone growth, their mixed performance across different regions, the intriguing success of their automotive equipment segment, and the mystery behind those significant increases in expenses. But we're just getting started. Stay with us as we continue our exploration in the next part of this deep dive, where we'll dissect their financial statements even further and see what other insights we can uncover.
Let's delve a little bit deeper into that significant decrease in consolidated cash and cash equivalents.
Okay.
Examining the statement of cash flows, we see a substantial outflow from financing activities, totaling INR 1,589.34 million.
Okay.
That's where a big chunk of that decrease went.
Okay. Financing activities.
Yeah.
For our listeners who might not be financial analysts, could you break that down a bit further? What exactly falls under that category?
Sure. Financing activities involve transactions that deal with a company's capital structure.
Okay.
Things like borrowing and repaying debt, issuing and repurchasing stock, and paying dividends to shareholders.
Right.
In LG's case, a significant portion of this outflow was for dividends and the repayment of short-term loans.
So they're rewarding investors and being fiscally responsible by reducing debt. But I'm curious, could this emphasis on deleveraging, paying down debt, also indicate a lack of confidence in investing for future growth? Are they being a bit too cautious?
It's a great point, and it's a question worth considering.
Yeah.
While reducing debt is generally seen as a positive move,
Yeah.
it's crucial to analyze, the motivation and timing.
Right.
Are they prioritizing short-term stability over potentially lucrative growth opportunities? It's a balancing act.
Yeah.
And in LG's case, we need to consider this in light of their stated growth targets and the investments they seem to be making.
Yeah. It's like they're playing it safe on one hand,
Yeah.
but on the other, they're making some pretty bold moves.
Right.
Now, let's shift gears a little bit and look at their assets and liabilities.
Okay.
One thing that jumps out is the significant increase in inventories. From INR 6,222.30 million to INR 6,862.64 million.
Okay.
That's a pretty substantial jump.
It's a sizable increase.
What could be driving this?
There are a couple ways to interpret it. On a positive note,
Okay.
it could signal that LG is anticipating a surge in demand and is proactively building up their stock of raw materials and finished goods.
Right.
This could be in line with their projected growth,
Yeah.
especially if they're confident in securing new contracts or expanding into new markets.
So they're stocking up, ready to capitalize on future opportunities. Makes sense.
Right.
But I imagine there's a flip side to this as well.
Of course, a rapid increase in inventories can sometimes be a red flag.
Okay.
It could suggest potential inefficiencies in managing their supply chain, or it could even indicate a slowdown in sales, leading to unsold inventory piling up. To gain a clearer perspective, we need to look at their inventory turnover ratio, which measures how efficiently they're moving their inventory.
Right.
A decreasing turnover ratio could be a cause for concern.
Okay, so a closer look at that ratio would give us a better idea of whether this inventory increase is a strategic move or a potential warning sign. Now, what about their borrowings?
Okay.
Their consolidated statement shows a significant reduction from INR 5,408.75 million to INR 4,430.72 million.
Okay.
This seems to align with their focus on deleveraging that we discussed earlier.
Yes, it does. Reducing debt can improve their financial stability and reduce interest expenses,
Right.
which can be attractive to investors.
Right.
However, we need to dig a little deeper. Is this reduction driven by a strategic plan to optimize their capital structure, or is it a reactive measure?
Okay.
Are they perhaps facing tighter credit markets or feeling pressure to conserve cash in light of the uncertain global economic outlook?
So while it appears positive on the surface, there could be underlying factors that we need to consider.
Right.
It's like a financial mystery novel.
Yeah.
Each piece of data is a clue that helps us unravel the bigger story.
Exactly.
And speaking of clues, let's talk about those expenses.
Okay.
We saw a 7% increase in employee costs and a 24% jump in other expenses.
Right.
The analyst call didn't really provide much detail, but those are significant increases
Yeah.
that warrant further investigation.
Absolutely. Those expenses are crucial pieces of the puzzle.
Yeah?
To understand their impact, we need to break them down.
Mm-hmm.
For example, is the increase in employee costs due to salary hikes, new hires, or maybe investments in training and development?
Right.
Each scenario tells a different story about LG's priorities and their outlook for the future.
Right. And what about that big jump in other expenses? What exactly falls under that category? Could it be increased marketing and advertising costs as they try to boost sales in those struggling markets? Or are they facing higher input costs due to supply chain issues or inflation? And we can't forget about research and development. Are they investing heavily in innovation? Perhaps developing new energy-efficient compressor technologies?
You're spot on. Without more granular detail, it's difficult to assess the full implications of those expenses. It's possible they're making strategic investments in areas that will drive future growth, even if it means taking a short-term hit to their profitability.
Right.
Or it could be a sign of operational challenges that need to be addressed.
Right.
Either way, these expenses are a key piece of the puzzle that we need to keep in mind as we analyze LG's overall performance and future prospects.
All right, so we've dug into their cash flow, their assets and liabilities, and those intriguing expenses. We've seen some potential red flags and some signs of strategic investment. But how does this all tie together? What's the overall narrative?
Well, if we look at everything we've uncovered so far, LG seems to be at a crossroads. They're demonstrating strong growth, especially in their standalone operations.
Yeah.
And they're actively managing their debt, but they're also facing headwinds in certain markets and grappling with rising expenses. The key question is, how will they navigate these challenges and capitalize on opportunities to achieve their ambitious growth targets?
That's the question we'll explore in the final part of our deep dive.
Right.
We'll analyze their outlook, consider the broader industry landscape, and see if we can predict what the future holds for LG Equipment's Ltd. Stay tuned for the exciting conclusion. We spent the last two segments really dissecting LG Equipment's Ltd's financials. We saw a strong standalone performance, intriguing growth in their automotive segment, and those significant cost increases that have us all wondering what they're really up to. So let's tie it all together. What does this tell us about LG's future prospects?
Well, LG's at a fascinating point in their journey.
Yeah.
They're showing strong performance in India,
Right.
strategically managing their debt, and making what appear to be significant investments for growth. But they're also facing challenges in certain global markets
Right.
and dealing with rising costs. The question is, will their strategic bets pay off?
And that brings us back to their outlook for Q3 FY25.
Right.
They're projecting similar growth to Q2, which we've already discussed, might be ambitious,
Yeah.
given the global economic climate and some of their regional struggles.
Yeah.
But if we connect that projection with their financial activities, particularly the decrease in cash and cash equivalents, it makes you wonder if they're preparing for something big.
It does raise that possibility. They've stated that they're not afraid to spend if they believe it will lead to greater success down the road. So are they gearing up for a major expansion?
Yeah.
Perhaps an acquisition
Right.
to bolster their presence in a key market?
Right.
Their actions suggest they're not content with simply maintaining their current position.
So they're not just riding the waves, they're paddling hard, trying to catch the next big one.
Yeah.
But as we've discussed, there are risks involved. The global economy is volatile, and competition in the compressor industry is fierce. What could this aggressive approach mean for their competitors and the industry as a whole?
Well, if LG is successful in executing their strategy,
Right.
it could disrupt the competitive landscape.
Yeah.
Imagine if they leverage their strong position in India, combine it with their growing presence in the Middle East and Europe, and then make a strategic acquisition, say, in North America.
Right.
They could become a truly global player, challenging the established giants in the industry.
That would definitely shake things up.
Yeah.
But it all hinges on whether they can effectively manage those rising costs and navigate the economic uncertainties.
Do you think their strong cash position gives them enough of a cushion to weather potential storms?
That's the million-dollar question. While their cash position is healthy,
Yeah.
a lot will depend on their ability to control costs
Right.
and generate returns on their investments.
If they can successfully manage those factors,
Yeah.
they could emerge as a major force in the industry. But if their bets don't pay off, they could find themselves in a vulnerable position.
It seems like LG Equipment's Ltd. Is a company to watch very closely in the coming quarters. Their story is a great example of how financial analysis goes beyond simply crunching numbers. It's about piecing together a narrative, understanding the motivations behind the data, and using that knowledge to assess potential outcomes.
Exactly, and as we've seen with LG,
Yeah.
those outcomes can be both exciting and uncertain.
Right.
They're a company on the move, willing to make bold decisions to achieve their goals.
Mm-hmm.
Whether they succeed or stumble,
Yeah.
their journey will be one to follow.
So for our listeners who are interested in LG's story, we encourage you to continue exploring their financial reports, consider the broader industry trends, and see what insights you can glean from their actions. What do you think their next strategic move will be? Share your thoughts and continue the conversation. We'd love to hear your perspectives.
Remember, financial analysis is a continuous process of learning and discovery. And in the dynamic world of business, there's always a new story unfolding. Until our next deep dive, keep those analytical minds engaged.